Hello, welcome if you are new here. This video is a brief analysis of McDonald's shares. To do this, we will analyze various parameters of the company, and finally try to reach an approximate value to the fair value of the stock, and compare it to the current price. Let's analyze the following parameters: growth, dividends, assets and debt, profit, number of outstanding shares, and finally the price. But first, let's get into a brief introduction to the company. McDonald's Corporation is the world's largest fast food restaurant chain, serving about 68 million customers a day in 119 countries through 37,000 outlets. Originally from the United States, the company began in 1940 as a small steakhouse operated by Richard and Maurice McDonald. If you're curious about the company's history, I recommend the movie The Founder. Contrary to what many people think, the company's main source of income comes not from the sale of food, but from land rental. What do you mean, you don't know? What happens is that McDonald's owns all the land where the franchises are located, which in turn are rented to franchisees. This way of operating makes McDonald's the second largest real estate entity, only behind the Catholic Church. Growth. McDonald's has on average seen earnings per share growth of 13% per year over the past 5 years. Gross revenue decreased from $25 billion in 2016 to $22 billion in 2021, having fallen on average 2.5% per year in the same period. Net income increased from $4.8 billion to $7.22 billion in the same period. Finally, free cash flow increased from $4.22 billion to $6.65 billion in the last 5 years, and averaged $5.3 billion a year. Dividends. With a dividend rate of 2.2%, the company distributes about $4.2 billion years to its shareholders. If we compare this value with the average free cash flow of the last 5 years, $5.3 billion, we can see that dividends consume a considerable part of free cash flows. In addition to being used to pay dividends, free cash flow can also be used by a company to repurchase shares, pay dividends, reinvest in itself, or make acquisitions. Assets and indebtedness. Total assets are $52.6 billion, and total liabilities of $60 billion. Subtracting these amounts have the company's net worth, negative $7.4 billion in 2020. Current assets are $6.2 billion, and current liabilities are $6.18 billion. If we divide the total debt of the company, on the average free cash flow of the last 5 years, the $5.3 billion that we calculated earlier, we see that the company will take more than 11 years to be able to pay all its debt with the free cash flow it generates. Since for me this figure should remain below 5 years, I consider McDonald's a company with a relatively high level of indebtedness. In addition, current assets are virtually identical to current liabilities, meaning that the company may have difficulty paying the debts it has in the short term. Not to improve the fact that the total debt of the company is higher than its assets, in a very simple way we are buying a debt of -$7.4 billion valued at 192 miles. It certainly won't be for the estate that we're going to want to invest in this company. Profit. McDonald's, for the past 5 years, has always posted profits, and had a return on investment of 15.8%. Gross and net profit margins are 53.7% and 15% respectively. Number of shares in circulation. Outstanding shares decreased from 0.794 billion in 2016 to 0.745 billion in 2021, representing an average of -1.3% per year. What impact does the change in the number of shares have on an investor? For example, if a company is divided into 10 shares, if I own 1 share it means I have 10% of the company. If suddenly the quoted concerned issues more shares, for example, for a total of 12 shares, it means that my stock now represents less than the original 10% of the company. However, there are situations where it can be advantageous for a business to issue shares. For example, if a CEO of a company thinks that the shares are being traded at a higher value than the amount he thinks they are worth, then issuing shares could be an alternative form of financing to take on debt. Thus, in addition to not having to pay interest on the borrowed capital, eventually in the future if the shares are corrected and fall to their fair value, the company can then repurchase the same number of shares it issued earlier for a lower value. Price. Currently the company has a market capitalization of $192 billion. Current earnings per share is $9.70 per share. Dividing the current share price by this value, we have a profit over earnings price of 27. Finally, to get an idea of the fair value of the company, we can divide the total price of the company by the average free cash flow of the last 5 years, which gives us an approximate multiple of 36 times. Based on a multiple of 20 times, at first glance it may seem that the company is considerably above its fair value. However, the multiple of 20 times is just a starting point. Better companies deserve higher multiples, and vice versa. Furthermore, past results are not proof of future results. Conclusion. In short, McDonald's has high price multiples and moderate growth. It has a negative net worth, and current assets are virtually equal to current liabilities. The company's debt is also relatively high. One point in favor of the company is its return on investment, however it takes little advantage of it because it distributes most cash flows through dividends. Perhaps the strength of this quote will be the status and recognition of your brand. I hope you enjoyed this brief and simplistic analysis. The numbers used are rounded values, and the opinions given are just my personal perspective. It is not a recommendation. Leave suggestions in the comments of actions that would like to be analyzed in next videos. Thanks for watching and good business.